Hello and welcome to today's video on how to read financial statements. Understanding financial statements is crucial for anyone who wants to make informed decisions about their personal finances or investments. In this video, we will cover the basics of financial statements, the most common types of financial statements, and how to use them to make informed decisions. So let's get started. So what exactly are financial statements? In simple terms, financial statements are reports that provide information about a company's financial health. They show how much money a company has, how much it owes, and how much it's made over a certain period of time. There are several types of financial statements that companies use to communicate their financial information. The most common types of financial statements are the balance sheet, income statement, and cash flow statement. Financial statements are used by investors, lenders, and managers to assess the financial performance of a company and make informed decisions about future investments or loans. So, where can we find these financial statements? We can find them under a company's investor relations, such as Apple's. So, if we search up Apple's investor relations, we can just go straight to the first link. We'll scroll down a bit and we'll find their financial statements PDF. And we will get their income statement right here, their balance sheet, and their cash flow statement. You could also find them on places such as, say, Yahoo Finance. Go right here and say Apple again. We'd see their summary, company's insight, all this stuff. We'd go to their financials. And we would see here their income statement, balance sheet, and cash flow. And it would be in this format. It's a bit different, seeing as it shows like different periods, so you can easily compare them. But they will essentially have the same information. We'll close all these out. Okay, so let's move on to the income statement. An income statement is a financial document that shows the revenue, expenses, and profit of a company over a specified period of time, typically 1 year, or in the accounting world, it would be considered 1 fiscal year. It provides information about how much money a company has made, how much it has spent, and how much profit it has generated. An income statement typically has 2 main sections: revenues and expenses. So we could see here, this would be the revenue section, this would be the expenses section, and then we'd have our other income, other expenses over here. The revenue section shows the total amount of money the company has earned from the sale of goods or services. It provides information about the company's top line, or how much money it has generated from its core operations. The expenses section shows the total amount of money the company has spent to generate its revenue. This includes costs such as materials, labor, and overhead expenses. The difference between revenue and expenses is considered the company's net income or net profit. If the revenues are greater than expenses, the company would have a net income. And if the expenses are greater than the revenue, the company would have a net loss. You can see here, this would be where the net income / net loss would be recorded. Now let's look at how to actually read a income statement. And to make the most of an income statement, it is important to know what to look for and how to interpret this information. So know exactly what the terminology means, know what revenues are, expenses, net income / net loss. Look for trends. Compare income statements from different periods to see how the company is performing over time. You could see if we went to like Yahoo Finance, they showed the income statements, the values of, say, net sales, interest expense, your net income over They compared it to different income statements. They had all those values listed right next to each other. You should be looking for trends in revenues, expenses, and net income. And this is to see how the company is performing over time. So you can see if it's a good investment or not. And last, you should pay attention to net income. You should see if the company has a positive net income or a negative net income or a net loss to see if the company is making profit. And these are some definitions that I went over before. You could pause the video here and note them down. Okay, now moving on to the balance sheet. A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. This shows the company's assets, liabilities, and owner's equity, or some people refer to as shareholders' equity. This one refers to it as stockholders' equity. Either one, it's basically just the equity of the company. So this shows important information about the company's financial stability and its ability to pay debts, which is very important. So a balance sheet typically has three main sections: assets over here, liabilities, and equity. So the assets section basically shows the total amount of resources owned by the company. This includes items such as cash, investments, and property, plant, and equipment. There's also intangible assets, and then you calculate the total assets over here. And the liabilities section shows the total amount of debts owed by the company. This includes items such as loans, accounts payable, and credit card debt. And total liabilities are added up here. Now your equity section shows the residual interest in the assets of the company after liabilities have been deducted. So this includes items such as common stock and retained earnings. So basically, your equity would be calculated here, and your total liabilities and stockholders' equity would be added up. And the point of the balance sheet is to see if assets equal liabilities and plus equity. And in this case, they do. Okay, now how to read the balance sheet. Make sure you understand what assets, liabilities, and equity mean, and understand which accounts go under them. Look for trends, compare balance sheets from different periods to see how the company is performing over time. Look for trends in their assets, their liabilities, and their equity to get a sense of the company's financial stability and to see if they can pay debts. Assess the liquidity of the company. Liquidity refers to the company's ability to pay debts in the short term. To assess liquidity, look at the company's current assets, which is right here, and compare them to the company's current liabilities over here. So you would compare these two numbers, total current assets and total current liabilities. Now you pay attention to ratios. Ratios are a useful tool for evaluating a company's financial performance. For example, the debt to equity ratio measures how much debt a company has compared to its equity. To calculate this ratio, divide a firm's total liabilities by its total shareholder equity. A high debt to equity ratio may indicate that a company is taking on too much debt, while a low ratio may indicate that a company is in good financial health. So you're going to take this total liabilities number, and you are going to take this total stockholders equity number, and you are going to divide them. That's how you get your debt to equity ratio. And you would want a low ratio, obviously. And these, again, are terms that we have went over before. Make sure you are familiar with them. You can pause the video here and take notes. Okay, so the cash flow statement. The cash flow statement is a financial document that shows the flow of cash in and out of a company over a specified period of time, usually one fiscal year. This provides information about how much cash a company has generated and how it has used its cash during the period being reported. A cash flow statement typically has three main sections: cash flow from operating activities, from investing activities, and from financing activities. And then we have the net increase in cash during the year. The cash flow from operating activities shows the cash generated from the company's core operations, such as the sale of goods or services, and changes in current assets and liabilities. This section provides information about how much cash the company has received from its customers and how much it has spent on operating expenses. Next, we have our cash flows from investing activities. This section shows the cash generated from the purchase or sale of long-term assets, such as real estate or equipment. This provides information about how much cash the company has invested in its business and how much it has received from the sale of assets. The cash flow from financing activities shows the cash generated from financing activities such as issuing bonds or taking out loans. This section provides information about how much cash the company has raised from investors or lenders and how much it has used to repay debts. And then this would be the net increase in cash during the year. So you take the cash at the beginning of the year and the cash at the end of the year. You take the net increase in cash during the year plus the cash at the beginning of the year to get your total cash at the end of the year. So now how to read it. Again, know the terminology. There's more words, more terms that you need to know for the cash flow statement. You need to know net income, which we have gone over during the income statement. You need to know operating activities, investing activities, and financing activities. Look for trends. Again, compare cash flow statements from different periods to see how the company is performing over time. Look for trends in these three separate categories to understand how well the company is doing in terms of how much cash they are bringing in each year. And again, pay attention to net cash flow. See if the company is having a positive net cash flow or a negative net cash flow. A positive cash flow indicates that the company has more cash available for future investments or to repay debts, while a negative net cash flow indicates that the company is using more cash than it is generating. And again, these are definitions that we have gone over previously. You can pause the video and take notes. So in conclusion, understanding financial statements is crucial for anyone who wants to make informed decisions about their personal finances, or investments. By knowing what to look for and how to interpret the information, you can use financial statements to make informed decisions and assess the financial health of a company. And that's it for today's video on how to read financial statements. I hope it helped you, and thank you for watching.